Hi there, and welcome to Picking the Right Strike. I'm Mark Sebastian, founder of OptionPit.com. Before I started Option Pit, I was a floor trader for about a decade on the CBOE and the American Stock Exchange. After I left the floor, I started Option Pit. We are an education consulting firm. We work with institutional firms, helping them implement and optimize option strategies. We work with retail traders, teaching them how to approach trading like a professional trader. We teach retail to trade like a pro. So today, we're going to learn how volatility affects option prices. We're going to discuss when to buy and when to sell options. We're going to match the right strike to an option purchase and the right strike to an option sale. Implied volatility. So what makes trading volatility, or the volatility of a stock, different than the actual stock? And the answer is, over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. Implied volatility is mean reverting. It goes back to a normal. So this is Apple. This is a 3-month chart of Apple. Now, if you can tell me where there's a mean there or some mean reversion over this chart, good luck. The 50-day is going straight up. The 200-day is edging lower. There is not a lot of mean reversion here. If anything, it looks like a set of stairs. Now let's look at VXAPL. VXAPL is the VIX of Apple. It is the implied volatility in Apple options. And we can see that there are some real spikes, but the red line representing that 50-day moving average seems to kind of meander, and the gray line, which is the 200-day moving average, well, you tell me, that thing does not move very much at all. It ranges between 26 and 30, and 28 seems to be the mean for this thing. So the thing to remember with mean reversion in options is a stock can go anywhere and stay there. And while volatility can go anywhere, it can't stay there. It will revert back to its mean over time. And understanding this can help you with buy and sell decisions when it comes to options. So in general, when implied volatility is low in the near term, and especially in the long term, and one wants to play direction, it can make sense to buy instead of sell. And when IV is high or normal, it typically makes sense to sell options or call and put spreads. So getting long. All right, if one wants to get long, one can sell puts or buy calls. And each trade acts very differently despite being long the exposure to the underlying. So a short put is going to be long exposure to the underlying and short exposure to volatility. This means that it wants the underlying, the stock or index, to go up, but it wants movement, so how much that stock or index is moving, to actually fall. So what you're actually hoping for is the stock price to move higher and the implied volatility to drop, or the volatility as a whole to drop. So what makes implied volatility drop? It drops because movement drops. So when you are selling puts, what you're really making a bet is that there's going to be less movement, lower realized vol. And so what I want one to think about in selling puts is that you're really making a bet that the underlying won't go down, not that it's going to go up. And that's a very different approach. Right? Think of it as playing not to lose instead of playing to win. And there could be very good reasons to play not to lose. All right. A short put is like going for a tie in hockey because you want to get the point. A long call is long exposure to the underlying and long exposure to volatility. A trader is actually hoping the underlying goes up and volatility goes up. So what makes that happen? An increase in movement or an increase in expected movement. So if you're looking for an increase in movement, you're absolutely betting the stock is going to go up. So when you buy a call, you're betting that the stock's going to go up. You're not looking for it not to go down. So you need movement. So here is a chart of Apple. And what I want to point out is that there are some times where the implied volatility is really low and it maybe makes sense to buy calls. And there are times where implied volatility is high and it makes sense to sell puts. So this red line represents implied volatility. So take a look. Apple hasn't made a lot of movement and implied volatility is relatively high over the last 3 months. Well, maybe it makes sense then to sell a put if I think Apple is going to stay here or go higher. Meanwhile, take a look at some of the time periods like in here, when implied volatility was necessarily relatively low. I mean, I could have bought an Apple option for very cheap here, and look at the way it goes up. Same thing here, take a look. I could buy here, and Apple just climbs. Pretty simple. Meanwhile, if I wanted, obviously there's earnings. See that E? But maybe it would have made sense to do some sort of put sale in July. All right. So now let's talk about getting short. Like going long, when one is making buy-sell option decisions, one must take the volatility into account. So when IV is high and one thinks the stock is going to go down, is going to go down, all right, one can sell calls or call spreads. And when IV is low and one thinks the stock is going to fall, buy puts. So here's GLD. And, you know, take a look here. The implied volatility of GLD was extremely low here. So if I thought gold was going to fall, this was an excellent time to buy options. On the other end, take a look here and here. And even here. Those were excellent times to consider selling options. So it's very important to pay attention to what implied volatility structure is telling us about how to form our position. So now, strike selection is really the difference between a good trade and a bad trade. So now that I've got an idea on whether I want to buy or sell, I need to pick my strike price. And this is done based on the certainty of the next volatility move. If one is a seller of options, one wants IV to go down. Some options take better advantage of IV dropping than others. If one is a buyer of options, one wants IV to go up. And some options take advantage of IV moves up better. So now we're going to talk about this concept of a hard versus a soft delta, or hard versus soft underlying exposure. All right. A hard delta or a hard exposure is relatively resistant to changes in volatility. So if I buy hard exposure, it is not going to be sensitive to changes in implied volatility. So hard options are going to be in the money and generally at the money. And that's because when I'm right, at the money options become in the money options. Soft deltas, all right, or soft exposure is relatively dependent on changes in volatility. So a soft exposure is going to be an out of the money or a far out of the money option. So understanding the difference will help with strike selection. So when would you want to buy a hard exposure? When would you want to buy an in-the-money option? All right. When would you want to sell an in-the-money option? All right. So you want to buy an in-the-money option, a hard delta, when one isn't sure of the IV's future movement and when what IV is very high. So IV is very high, but it might go higher, might go lower. All right. Or I'm not sure which direction IV might move. Well, and I want to go long. I want to buy an option because I do think it's going to go up. The stock's going to go up, or the stock's going to go down. Well, then a lot of times it does make sense to buy an in-the-money option or an at-the-money option. Now, with selling, same thing. When I'm not sure of the future IV movement or IV is really low, that's when I want to sell in-the-money options. So here's an example. Take a look at this chart of Goldman Sachs. And take a look at this implied volatility right here. All right. Now, I think Goldman is going to go higher. You can actually see I'm right. So let's take a look at buying an in-the-money option versus an out-of-the-money option here with implied volatility high. And what I want you to notice is that the implied volatility on the 110 strike is 29.6 and the 125 strike is 26.5. Well, I am right, and take a look at the changes in price. I paid $96 and $7.60, and at the end, if I sold so I paid the offer, I sell the offer. I sell my 110 call at $10.65, and or I sell my 125 call at $119. Well, let's compare these on a dollar basis. And I do want to point out, take a look at that implied volatility change. My 110 calls dropped 2 points. My 125 calls dropped 4 points. That was because they were out of the money. So on 11/15, I could have bought one December 110 call for $7.60. Spent $760. Or I could have bought 8 of the Goldman Sachs December 125 calls for 96 cents. So in case 1, I buy one option and I spend $760. Case 2, I buy 8 options and I sell $768 and I spend $768. Well, 8 days later, let's take a look at which worked. Well, if I sell my 110 call at $10.65, I make a $3.05 profit. That's $305 for one call. Hey, that's almost 50%. That's not bad. When I sell my 8 Goldman Sachs 125 calls, I make $1.19. At $1.19, I make a total profit of 23 times 8, or $1.84. So I make $184 on 8 calls. So would I rather spend $760 and make $305, or spend $768 and make $184? Well, clearly, the in-the-money option was the better trade, and that is because implied volatility was high. So when implied volatility is high, and you've got a directional opinion, it makes sense to go in the money. Now, those soft deltas are way more sensitive to IV changes. And there are some very specific times where they can make a lot of sense. So when I'm buying options, I buy options when implied volatility is really, really, really low, or when I'm expecting a major move. That's when I buy those soft deltas. I buy those out of the money options. And when I'm selling these soft delta out of the money options, all right, I sell out of the money options when I think IV is really, really high. And when I expect movement to stop, but think there could be a little more price action. So if I think movement is going to slow down, and I think IV is really high, that's when it makes sense to sell. So let's take a look here. Here's IBM. And I want to point out, look at how low that implied volatility is. So take a look. I buy options and it goes up. Well, let's take a look. I could have bought on the 21st, I could have bought a 185 call for $6.80, or I buy 5 of the 195 calls for $1.22. Look at those implied vols, 16 and 13.20. Well, 2 days later, I was right. Nice little swing trade. And I sell my 185 call at $9.30. Notice the implied volatility increased. Or I can sell my 5 calls at $2.25. And again, notice that implied volatility increase. Well, let's take a look. On November 21st, IBM closes 190.29. On the 23rd, it's up $3. So I spent $680 buying one of my 185 calls. I buy 5 of my December 195 calls for $122, spending $610. So I spent $610 on 5 calls, or I can buy 1 call for $680. Well, a couple days later, I sell my 185 call at $9.30. $250 for a call. Hey, you know what? Not bad. Good job. Never gonna give anybody trouble for making $250. But take a look at my 5 out of the money calls. They make over $1 in profit. I make $515 on my 5 calls. That's almost 100% in 2 days. And that is because that out of the money exposure, volatility was low. And when volatility is low, in this case, I wanted to buy at a soft delta. So obviously the opposite is true on selling. If I was selling, I would have been far better off selling the in the money and losing $250 versus $515. So that's the thing to remember, is that if IV is really low, all right, I want to buy soft deltas or sell hard deltas. And when IV is really high, I want to buy hard deltas or sell soft deltas. So in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for different positions. There's different types of exposure. And is the position sensitive to changes in IV? Depending on that, I may want to buy hard exposure or sell hard exposure, buy soft exposure or sell soft exposure. Thank you very much and have a great day. We'll see you next time.